Good morning. This is Travis Bement with YourOrlandoMortgage.com, and this is my economic and mortgage commentary for the week of August 31st, 2009. Based on recent events, I felt it was important that everyone know a little bit more about capacity and how it affects everyone in the mortgage and real estate arenas. Last week, a realtor asked me if it was really taking 45 days to close a loan. I told them that at the mortgage firm, that was certainly not the case, but it was taking longer than it was just a few weeks ago. Many banks, hit hard by staffing cuts, are taking that long. While I use the difference as an opportunity, it brings to light a very obvious issue: capacity. Since the real estate and mortgage crisis hit in 2006, we have seen demand for mortgages steadily decrease. That said, there will always be a demand for mortgage, and some of that lost demand will return as the economy improves. While the decrease in demand has started to slow, the loss in the supply of mortgages continues to increase. Scores of lenders are out of business, and a number of loan products have disappeared. Hundreds of millions of dollars in capital available to lend on mortgages has also gone away. Add to that the loss of jobs for thousands of mortgage processors, underwriters, and other support personnel. The industry is at a point now where we may be unable to meet even the basic levels of demand. The recent failures of Colonial Bank and Taylor Bean & Whitaker have put pressure on everyone who is left. In the space of a few days, the turn times for processing and underwriting doubled even tripled in some places. The delays, like those we saw in late May and early June of this year, were causing files to take 3 to even 4 more weeks to be completed. What does that mean for borrowers? Well, this could mean potentially higher rates and fees due to the lock extensions and lost opportunities for closings on properties. The landscape from here does not look much better, as more lenders and more banks will fail in the coming months, further reducing the available supply for borrowers. The turn times required to process and underwrite files may continue to increase and cause additional strain on an already strained real estate and mortgage system as they fight towards recovery. The other big risk is interest rates. There's somewhat of an inflationary pressure on rates due to the lack of supply, and that could potentially cripple the recovery of our financial system as a whole. In some other news, Congress is working on legislation that will extend the HOME Act of 2009. The HOME Act provides a one-time tax credit of $7,500 to first-time buyers. The credit is due to expire December 1st, 2009. Based on the fact that many analysts believe our economic recovery will begin as a jobless recovery with little to no employment growth in the beginning, various forms of legislation working through Congress would extend the benefit to all home purchases, increase the award to $15,000, and possibly even remove income limitations on the benefit. The goal is to keep home sales moving and stimulate further sales. All of this will also help to avoid foreclosures. Also of note, the Federal Reserve has made over $14 billion in profit in TARP loans and other bailout loans since its inception. Thank you. This is Travis, and we'll see you next week.